Talking about microcap stocks, they were the hottest strategy in the last quarter of last year and before this year's Spring Festival. However, with continued significant declines in the second and third quarters, microcap stocks faced their biggest 3 consecutive drops in nearly 4 years. The index fell over 50%, with year-to-date losses still high at -20% by late September. The market criticized the style of picking small and poor stocks logically and voted with their feet to abandon it. However, anything can happen in the capital markets, and with unexpected monetary policy, market sentiment was ignited. The short-term stock market index clearly rebounded, and with this rebound, sector differentiation became more pronounced. By the end of October, large-cap firms had an absolute monthly increase of around 20%, while small-cap stocks rose by an absolute 40%, showing a huge gap. It's worth noting that the policies that sparked this trend can be summarized as providing targeted liquidity to brokerage firms, while also improving real estate and company stock prices. Financial institutions have primarily invested in blue-chip stocks, while the sectors benefiting from the policies were real estate and liabilities, neither directly involving small-cap industries. The reason, as our research shows, is that the current fundamental environment is under pressure. In September, large enterprises' net profits fell by 27%, but the economy still has ample room for improvement. This has suppressed the value of blue-chip stocks that are priced based on industrial performance. Small-cap stocks, which may not show short-term growth, are more speculative and are easily influenced by capital due to their smaller market capitalizations. This results in a noticeable profit effect, explaining why brokerage and banks quickly fell, while sectors like tech and media remain near their highs. Of course, we should note that the last 2 waves of small-cap market rallies had clear paths. Whether it was the smart wearables in Apple's supply chain from 2019 to 2020 or the explosion of the renewable energy industry in 2021, both had good performance delivery. In the last 2 years, there has been no solid growth in technology innovation. Most small public companies face declining profit growth while high P/E ratios pose significant risks under these fundamentals. There's an old saying that bull market losses often exceed bear market ones. In this constantly shifting market, chasing gains and cutting losses becomes increasingly difficult. Timing the equity and derivatives markets is challenging. The price movements of these assets are complex and volatile. For individual investors, continuous tracking and professional analysis are difficult, and making informed investment decisions requires long-term experience and knowledge. Choosing a good manager is even harder than selecting a product. Public funds vary widely in quality, and private funds lack transparency. For investors, participating through a family office is an ideal way to access tailored investment opportunities. Compared to direct investment, this offers more expert guidance and asset management support.